Oil prices are set for big weekly declines. Welcome to Market Insight. I'm Ramzan Karamali. Well, Brent crude is down almost 4% and WTI is on track for a 6% decline this week, though prices are relatively steady this Friday. Earlier this week, the FT reported that Saudi Arabia is to abandon its $100 price target. Output in Libya is expected to increase once again too. Investors, though, are weighing these firmer supply noises against fresh stimulus from top importer China. So are oil prices likely to continue on this downward path? Well, to help answer that and more, I'm joined by David Fyfe, Chief Economist at Argus Media. David, thanks so much for joining us. Well, let's start with the move by Saudi Arabia potentially abandoning their $100 price target. Why do you think they would do it now, and just how significant could this be?
I think there's been a bit of pushback since that report came out yesterday. And indeed, certainly some of the sources we've been speaking to in the OPEC plus firmament saying, really, the Saudis have never stated a $100 per barrel target. And in fact, they're not necessarily chasing market share. But, they've had a set of planned production increases due to begin in December, although they retain the potential to defer those even further into 2025. So the market reacted quite aggressively to the downside yesterday with that report, but I'm not quite sure how much credence we should give to it at this stage.
But we also do know that OPEC Plus will go ahead with its plans to increase production by 180,000 barrels per day each month, starting from December. Do you think that's already been priced in, or do you think we could see prices falling further?
Well, I think the problem for OPEC Plus is that although market fundamentals presently look relatively tight, really the market's taking its cue from expectations for 2025. When we think supply and demand data suggest that we could see the emergence of a surplus next year. And really the recent downward shift in prices and the flattening of the backwardation in the curve have very much been focusing on what's expected for 2025. So I wouldn't be surprised if at some stage they might decide to either pause or even defer some of those production returns.
But we're also expecting more supply now from Libya. There have been quite a lot of problems there politically and especially over the central bank. How big a deal is it that they are getting more supply out there?
Well, we haven't actually seen very much in terms of incremental exports yet. I mean, there's 500,000 or 600,000 barrels per day of supply that has been offline for a period of time now. Certainly, there seems to be an agreement on the central bank, which was the key sticking point. But I think, we'll have to wait and see, and we'll believe those barrels when we actually see them coming back onto the market.
Now, I mentioned China in my introduction and the fresh stimulus measures. How much do you think prices are reliant on a buoyant Chinese economy, or do you think the Chinese are perhaps getting their oil from elsewhere?
Well, I think certainly when I was in Singapore a couple of weeks ago, the mood music there was very pessimistic about the Chinese economy and indeed about gasoline and diesel demand within China in particular. I think the fact that the authorities in Beijing have come up not only with some monetary loosening, but also some, a fiscal bazooka, if you want to put it that way, it shows how concerned they are. And if that gets consumers being a little bit less cautious and spending and traveling once again, then it could help put a floor under prices going forward.
If we do get lower prices, do you think they could be a factor in the upcoming US presidential election?
Well, I think both the candidates in the US presidential election have concerns about inflation, and the gasoline pump price is one of the key political bellwethers for the United States. So obviously prices $80, $85, $90 a barrel for crude, they risk pushing gasoline up towards the sort of psychologically important $4, $4.50 per gallon level. So I would have thought that both the candidates in the presidential election would be quite happy with prices closer to $70 Brent than they would be with $80 Brent.
David Fyfe from Argus Media, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.